Started. Welcome to our YIS online club meeting today. Today we're going to be going over Unit 5, Lesson 4, How to Forecast Revenues. Today I have with us Abhinav. Abhinav comes to us from California. He is part of our student advisory board. And little known fact, Abhi was the winner of last year's global stock pitch competition. So he has prepared a presentation for you guys today to go over forecasting revenues. And I'm super excited to have him with us today. So Abby, if you want to go ahead and share your screen, you can take it away.
Of course, thank you for that. Just let me know if you guys can see that. Just a slide of how to forecast revenues. So basically, yeah, today we're going to be talking about different ways of forecasting revenues, and obviously you can't predict everything in the future, but there's a lot of things you can do to kind of see the direction that a company is heading in and stuff like that. But before we get into it, yeah, so I want to talk about currently what's going on. So obviously anyone who's been following the market knows that GameStop, among other stocks, shot up a lot, and now it's kind of balancing out, but it did shoot up a lot. And I don't know, does anyone want to explain or think they know why that happened? Anyone on the Zoom call?
I think hedge funds were trying to short the stock, right?
Yeah, absolutely. So basically a bunch of hedge funds came together, and they're just like a bunch of institutional investors. So these are huge companies, have a lot of money. They came and they said, look, GameStop is not a great company, with online and digital games. Like, no one's really going to GameStop anymore. They're not a valuable company. Let's short this. So they started shorting GameStop, but basically a bunch of retail investors, so essentially people like me and you, who are not as big as these hedge funds, came together on like Reddit streams and stuff like that, different channels, and they said, let's just go against this, because a lot of times these big companies kind of control what happens. So they said, let's go against this. So they started buying a lot. So basically what this created was a short squeeze. So basically hedge funds were trying to short, but with so many people buying, it actually shot up. I think it was around a couple dollars, maybe $5, and it went to almost 300. So that's just really interesting to see how a lot of times the market can be dictated by things other than the actual value of a company. And that's just why it's so important to kind of know what's going on in current events and stuff like that. So next, this is kind of into our lesson of actually forecasting different revenues. So basically, future revenue is calculated by multiplying the average selling price of a company's product by the expected products sold. And the key word is expected, because obviously we don't know how many they're going to sell with different factors. And a good way to think of this is just like COVID-19. No one saw this coming, and it changed a lot of revenue streams and stuff like that. So basically, like I just said, revenue is based on a lot of factors. And if we take Apple, for example, if it simply sold iPhones for a larger price, a higher price, they would make more money. But this is dependent on the idea that they would sell the same amount of phones. But we all know that if iPhones suddenly became $2,000 instead of wherever they are now, a lot less people would buy them. So because of this, revenue doesn't actually increase proportionally to price. And Apple would love for both the price per unit and number of sold to increase. But a lot of times, if you increase the price, you sell less. But if you decrease the price, you sell more. So you're trying to find a sweet spot as a company for this. Other ways to kind of increase revenues are increasing the number of units sold geographically. So I don't know if you guys know, but a lot of semiconductors kind of grew by expanding to Asia especially. And that was a really big deal in revenues, and even their stock price benefited greatly just because they had news that they were kind of introducing into new markets in China and stuff like that. So geographic features are also a big thing, geographic expansion. And Also, there could be like negative effects as well. So as we all know, the iPhone is super popular, but Apple used to sell iPods before iPhones. So iPod sales actually went down a lot. So you can't just keep making more revenue with new products. A lot of different things are going to happen. So basically, you can get additional revenue also by taking share from competitors. And this is kind of the competitor section. So if in the world 1.2 billion smartphones are sold per year, and Apple currently sells 50% of those, but then next year it sells 75%, it'll see a revenue increase, obviously, because we're selling more phones. Also, okay, never mind. So this is known as taking market share or gaining market share. You're basically just getting a bigger share of what's already there. And this is what a lot of companies do. Like I was talking about geographically, you can gain market share by going into a new or really unsettled location, competitor-wise, and kind of take over as the main competition. And another way that they can do it is if the market itself is actually growing. And I'm sure you guys, if you've ever read news articles or watched anything about like semiconductors or like tech industries, they kind of mention like the market cap is constantly growing. So this is just basically, let's say 1 billion smartphones are sold this year, but next year 2 billion are sold because more people are buying smartphones. That's an increasing market cap. So even if Apple still sold 50%, they're selling 50% of a much larger price or a much larger number of units, right? So even if they can just maintain market share in a growing market, they're going to increase revenues. Also, some of the more simple ways of growing revenues are like new stores, new buildings, or like acquisitions are a big thing. And so basically this gets us to the three main topics, which are to forecast the revenues of a company, you need to evaluate the industry, the company, and the competitors. Looking at a company's revenue growth for many years is a good start of kind of seeing where they're at, but you also have to be careful with a lot of abnormalities because if we take the example of Apple, their revenue increased by over 50% in a couple of years because of just, they were introducing so many new products that were just so much better at that time. But then you can't expect them to grow by 50% every year because that's just not possible, that's not practical, and it's not realistic. So you have to look at a wide range, and you also have to take into account that really numbers can be inflated or deflated based on other factors. So you have to take into account what the company was doing, and also sometimes the industry just grows. Like I was talking about, like market cap growing. So that's not really the company doing a better job. It's just, you're just growing in that. So you have to take into account when you're trying to look at former data and stuff like this, what would happen. So I know you guys have an individual activity. So I just did a short example of one of the questions on this. And I chose AMD, which is a semiconductor stock. And basically, they sell semiconductor chips and stuff like that for computers, and they're constantly investing in research and development and stuff. So I did the question, how fast did the company grow revenues last year? And they actually increased by almost $3 billion from 6.7 to 9.7. So basically, when we look at this, we have to take into account a lot of different things. First of all, AMD introduced a lot of new products, and there were a lot of competitive products too. If you look at the news, AMD is challenging Intel and stuff. And Intel is a really established long-term company, and AMD is a little bit less involved, at least recently. But now it's one of the direct competitors to all of these large-scale companies, and that's a huge deal. When your product is good, you should expect to do better. And also, we have to take into account that the semiconductor industry in the past 2 years has been booming, especially even during COVID-19. We saw that semiconductor industry as a whole just grew a lot. So that also adds to the revenue. And then we also got other things like competition and just how AMD is functioning in general to bring this revenue. And we can kind of extract stuff from this by saying that they're a growth company. Obviously, we talked about products. That's always a good thing. Products kind of lead and drive a company. So that's something that you want to look for. And looking at their stock price, you can see that their revenue growth kind of shows this. In the last couple of years, they've grown tremendously. I think it was $19, almost $16, almost I think 2 years ago, and now it's close to I think $100 or $90. So it really shows. And obviously, you have to take into account the different factors, but you can find information like this on like Morningstar, Zacks.com, Yahoo Finance, and it's really cool just to see how companies grow. And sometimes you see companies actually take a step back. I think Apple actually went down by 5 billion or 5 million last year. And that was a lot because they didn't introduce that many newer products. And it was also COVID-19 and a lot less purchases in general. So it's really cool just to see how companies are doing. And hopefully you guys can do the rest of your individual activity with the different questions on some example companies. And I think if you guys want, it's really interesting to see two companies that are competing against each other. So I chose AMD, and a competing company is Applied Materials, another semiconductor company. So looking at the different revenue streams and the different share prices is really cool to see how they're interacting in the market and seeing if the market cap is growing and stuff like that. So hopefully you guys get to that because that's really interesting to see as a stock price. So this is kind of the ending part-ish of it. So basically, how do you forecast margins of a company? So when you're looking at stocks and stock prices, you're probably going to look at a company's income statement, balance sheet, and statement of cash flows. The income statement is basically just a financial summary of like operating results, the firm, what it does and what it's spending. And the first section actually shows gross margins. And basically this is just the revenue minus the cost of goods, which is just basically your profit and how much money you're making. So financial companies and service-oriented companies tend to have high gross margins because they have lower cost of good. It doesn't cost as much to produce those products. But industrial and manufacturing companies have much lower gross margins as they have a high cost of goods. So this is just an example for you guys, and feel free to jump in. So do you guys think the car manufacturing company, Toyota, has high or low gross margins?
Low.
Yeah, low. So that's correct because a manufacturing company, like we talked about, has low gross margins because it's high cost to produce the good. And this is kind of obvious if you actually look into how cars and stuff like that are produced. It takes a lot of factory production, a lot of oversight too, to make sure that everything's functioning and like detailing. So it's a lot of stuff that goes into it. And so car manufacturing has probably one of the higher cost of goods sold out of any industry because of the amount of parts that it takes to create a car. And this leads to lower gross margins. So if we take Apple versus Samsung, they both make smartphones and other technology products, but who would you guys guess has a higher gross margin? It's just 1 out of 2, so 50% chance of getting it right.
Wait, Apple and who?
Samsung.
Oh.
Apple.
Samsung?
Apple? Okay, that's a good guess. Do you mind telling us what made you come to that decision? Is it just you think Apple's a better company in general? You know Apple more?
I just feel like Apple products are a bit more expensive for like the same hardware.
Okay, see, that's really interesting too. So that is correct. So good job. Apple does have a higher gross margin. And basically, they charge a higher price, or even if they did cost. So basically, whether they charge a higher price or have lower cost of goods, this can lead to a lot of competitive advantages. So like you were saying, for similar hardware, their prices are higher and their cost of goods might actually be lower. I need to look into that, but basically they're producing quality products, but they might not be paying as much because of the mass production and stuff like that. So because they're selling for so much more money, they're just making more money per product. And I would even say that Apple products right now are probably more popular than Samsung products, even with the higher gross margin. So as a company, Apple is way more competitive, specifically for smartphones, than Samsung. So we talked about income statements and gross margins, but you can go past that and you'll notice operating incomes, or EBIT. So basically, operating income divided by total revenues gives us the operating margin. Operating margin is a measure of probability, or how much of each dollar of revenue is left over after both cost of goods sold and operating expenses. So operating expenses include stuff like payroll, sales commissions, marketing, travel and rent fees, and other general stuff. So it's probably easier to think about it if you think about buying some pants. So if you're in the mall and you want to buy some pants that cost $50, that's a nice pair, right? But they feel good and you do buy them. But if you find out that they only cost $20, you might think that you paid too much. But what you have to realize is that a lot of companies, it's not just the cost of production, but it's all of these operating expenses of getting it out of production line to ship it to different places through planes and cars and ship it, and then packaging and processing and all of that. There's so many things that go into it, and even paying employees, that their gross margin, even though it costs 20 to make and they sell for 50, because of operating expenses, their operating margin would probably be really small. So they only get about $5 of profit off of a $50 pant sold for $20. So I think it's just important to see that you can't just look at cost to produce and the price sold. You have to take into account all the other expenses that companies have. So that's basically all I had as a presentation for you guys. Does anyone have any questions? All right.
Great, thanks so much, Abhinav. I want to turn it over. Well, first of all, I want to say thank you. That was a great presentation that you did for us today on forecasting revenues. Super excited to have you with us today. Like I said, Abhinav was one of the winners of our global stock pitch competition last year. So I'm hoping that he joins us again this year. And looking forward to maybe working with him doing a stock pitch prep night sometime in March. Look out for that email, because we really want to have you talk to some of our students, give them some tips. I know you need to leave a little early, so I will go ahead and let you go. But thanks so much, Abby. It was great having you today.
Yeah, thank you guys so much for letting me do this. And thank you for everyone who listened. Yeah, have a nice day. And I hope you guys enjoy the presentation that follows. Thank you guys.
Thanks so much.
Of course.
Yeah.
All right, you guys. Well, I want to go ahead and introduce Rebecca. Rebecca today is our guest speaker. She is the founder and managing director at Bonds and Associates. She's also on our regional advisory board. Super excited to have Rebecca today. She's going to be talking about impact investing and what that looks like. So go ahead, Rebecca, as soon as you're ready.
Thank you very much, Christine. Hello, good evening, good afternoon to everyone. Good. All right, I jumped ahead. You got a sneak peek already. So as Christine said, my name is Rebecca Bonds, and I'm going to talk about impact investing today. And I would say I am only a few feet ahead of you on this journey. Impact investing is on the fringes of investment management right now. So I am learning about this in many ways as you are learning about it. So I want to say welcome and thank you for having me tonight, and introduce myself and tell you a little bit about myself. My background in investment management started back in 1990. And I started off in the investment world, and I have had a 20+ year career in investment management and portfolio management. I'm a CFA charter holder, and I have worked with private clients, institutional clients. I've worked in portfolio management. I've been a supervising portfolio manager. So way back when I started in the business, we didn't have anything called impact investing. We didn't have anything called ESG. And now and again, we have sometimes something called ethical investing. So because this is on the fringes, I'm going to make a fairly large proclamation to you. And I'm going to proclaim that this world of impact investing is going to move from the fringes to the mainstream. And that over the next 10 years, this will happen, and it could happen in even less time. And I'm also going to make this very bold proclamation that it's going to be your generation, Gen Z or Gen Z or Gen Connected, versus my generation, which is Gen X, that's going to have a really big part to play, and in fact be key drivers in this system change. So I want to look at the history and the continuum of investing. We talk about sustainable investing, we talk about impact investing. So where we start in this process is, the traditional aspects and the foundations of investing. Investment process based on traditional factors that you're learning here. Return on equity, debt to equity. And back when we started talking about, okay, what do we want to look at in terms of what's socially responsible for clients? It would be the client who would drive the process and tell us to avoid certain investments. Like, I don't want to invest in tobacco companies. I don't want to invest in arms companies. And what we would say to them is, that's no problem. Just be aware that we may leave some return for you on the table in your investment. We may not perform as well as the benchmark when we look at your portfolio. So it's amazing where things have come, because then we moved into environmental, social, and governance factors and looked at it from a risk perspective. So this involved integrating the environmental, social, and governance risks when we're looking at a company. Was that company subject to greater risk from these types of investments or these types of factors in their company? And the best we could get was neutral. Then we moved into socially responsible investing, and this focuses on buying companies that are doing better with their environmental, social, and governance factors. So, and we excluded those that did not. So again, some avoidance happening here. And then impact investing is really, again, on the fringes. It has really been only evolving over the last 10 years or so. And it's a strategy that includes not just looking for a positive return, it also includes looking at positive social and environmental impacts a company or an investment can make in the world. So we're going from looking at value in an investment to investing with our values. And those two worlds are starting to come together, which is a good thing. It's the evolution of our society. So I'm going to say, put your questions in the chat, and Christine's going to get ready and start a poll for us. And I'm going to ask you to take a look at these definitions of impact investing and pick the one that best resonates for you. So again, keep questions coming in the chat and take a look at this poll. We'll give you about 30 seconds to take a read through and just pick one that resonates with you. Thanks so much. We've got 50% in seeks to intentionally generate positive social and environmental impact alongside financial return. We've got 40%, we've got 33% now in investments made with the intention to generate positive, measurable social and economic impact alongside a financial return. We've got 17% in pursuing two goals at once, investment returns and social or environmental returns. So, and so far, as everybody, I think everybody's done. So we'll end the polling. And we have nobody who picked, let me see, refers to general investment strategy that not only generates financial returns, but also creates a positive social and environmental impact. So the winner is seeks to intentionally generate positive social and environmental impact alongside financial return. So thank you so much to all of you for taking part in this poll. I'm going to stop sharing the results now. and we're going to look at the definitions of impact investing. So everybody got a good look at my screen here? Thumbs up. Okay, thanks, Christine. Appreciate the head nod. Appreciate the head nod. The one that didn't cut the mustard for anybody refers to a general investment strategy that not only generates financial returns, but also creates a positive social and environmental impact. And that was the Investopedia definition. There's nothing really wrong with that definition. I think it's just bad grammar, but also it's really good that nobody picked it. So if we look, there are things that are consistent. Nobody was wrong in any answer they picked. There are things that are consistent between all these definitions. I'm looking at Brian Trelstad's definition. He is actually on the faculty at Harvard Business School. It's about pursuing two things at once: investment returns and social and environmental returns. Again, we've got a great definition there from Neuberger Berman, which is a manager out of New York, and the Global Impact Investing Network. So I'm going to break this down let's look at what's consistent between all of these definitions. Again, impact investing on the fringes of investment management. We haven't quite got it all figured out yet. In fact, I would suggest that we have a long way to go, and this is a great opportunity for you as you move forward in your lives. So what are the consistent things that we saw? One was the word positive, two is the word return, three is the word social, environmental, and the word and. It wasn't an or, like when I first started off in my career, that we had to choose between making the return or leaving a return on the table by excluding certain investments. The information in the Global Impact Investing Network is it's intentional. It's an intentional process of investing, and it's measurable. That's debatable right now. Again, this is on the fringes of investment management. So we've seen the words, we've defined it. What do the numbers look like for impact investing right now? So if we look at where impact investing stands in terms of the global capital markets, its market size is estimated as at the end of 2019 as 719 billion. Now, I know that sounds like a lot of money, and it is. But when we talk about it on a relative basis in relation to the global capital markets, that's bonds and equities. The global capital markets right now, as at the end of 2019, were $201 trillion. There is a difference between impact investing, social responsible investing, and ESG investing. When you combine them all together, you see that those types of investing are equal to about $12 trillion. So again, for those of you who are really focused on the numbers in this world, which is what we do here at the Young Investor Society, which is what I've done as a chartered financial analyst holder and as an analyst. The impact investing is the other side of our minds, which includes not only the numbers, but how do we qualitatively evaluate these investments? So before I go on, I'm going to pause, take a breath, see if there's any questions in the chat yet. Nothing yet. Okay. How am I doing so far? Is this resonating? Are there any questions? Okay. All right. Again, on the fringes, this is something that your generation is probably really going to drive as we move forward. And what's the why? And what's the why behind this? Why right now? Well, our value system is changing. Remember on that continuum where we saw that we originally would look at the value, the dollar number in investments and what the return was. We are evolving. We're looking not only just at the value, but the values. And I was at a webinar because nobody's going anywhere. I don't know about you, but we are locked down here I'm just outside of Toronto. So we're locked down here. So we take these virtual trips around the world. And I was at a webinar with the head of the UK Impact Investing Institute, the head of the Chartered Financial Analyst Institute, and a couple other really interesting people. And that whole idea that we're seeing a convergence between the value in investing and our value systems, this is becoming more and more mainstream. So what's accelerated this? Well, it's the global pandemic. This global pandemic has not only accelerated digital transformation, it has accelerated, the way we look at investing. And you'll see if you're reading any of the media, ESG is starting to show up more and more in terms of what you're seeing in the media right now and what you're seeing when managing client accounts. And our clients are becoming much, much more aware, which is great, which is what we want, and which drives us forward, which needs to drive us forward to adapt. And, for you, climate change, very much front of mind, I understand. For me too, as a Canadian and a lover of the outdoors. So that's the why. Why right now? Why is this taking on more and more prominence for us? But at the same time, the impact part of this continuum is still on the fringes. All right. Next, what are some impact investing? I want to compare impact investing themes to ESG factors. Because impact investing, again, on the fringes, it's in the theme stage. It's not at the actual factor. And can we measure it really, really well? We cannot at this point. So we look at ESG factors. If we're looking at a company, say it's a Microsoft, an Amazon, or an Apple, we may look at their environmental impact reports when we're reviewing a company. We may look at some of their environmental sustainability initiatives. And Christine mentioned a really great example when we were going over this today about Amazon and where they were headed in some of their initiatives. The social aspects. We may look at a company and we can measure pay equity. We can measure gender diversity in a company. That's very easy to measure. Governance. So that's the government at a company. We can look at a company and say, okay, is the chair separate from the CEO? Again, when I first started my career, a lot of times the chair and the CEO were the same person. So we can very easily measure these. Whereas impact investing, what are we focusing on? Sustainability. You also see that word used a lot as well when it comes to impact investing and sustainable investing and ESG. It's all kind of colluding together, trying to break it out a little bit. But sustainable agriculture, renewable energy, conservation, and affordable and accessible housing, healthcare, and education. And again, how do we measure that? There are some examples. You're starting to see charities now starting to use something called impact bonds. And I have to admit, again, I'm only a few steps ahead of you all on this impact investing journey and evaluating investments. It started for me only 2 years ago. I was sitting at a CFA conference, and you know how sometimes you get bored in school? You sometimes get bored in a conference. I gotta be honest. And then this panel came on the stage, and there was someone there from government. There was someone there from a charity. There was someone there who was a philanthropic investor, and there was someone there from an innovation center. And I'm going, okay, this is a little different group of people who are all working together. So that's when this started to show my radar scope. So yeah, again, I am only a few steps ahead of you, but one of the things that charity talked about is they had developed an impact bond. And what the issue was is they were doing it for affordable housing, but how do you measure the impact that bond has made, and how do you measure the return? Return's fairly simple. The impact it has on that housing development was a little harder. So there's both the numbers behind impact investing as well as the touchy-feely, the soft, the qualitative factors that we have to take into account. looking for examples of impact investing that you may see when you look around and Google. There are some ETFs, some exchange traded funds out there. If you Google it, some focus on clean energy, some focus on housing development. And where you're seeing impact starting is actually in private equity. So before it gets to you guys, when a company is first being developed, when it's first being incubated, in fact, today, and as you move forward in your careers, in your professional lives, in your lives, these companies that are being formed now, they actually build the social impact piece into their business plan. So it starts right away. Might see a company, again, not publicly listed, but saying, you know, we do this, this, and this, and this is the charity that we support. And that just comes right off their top line revenue number. So again, I'm going to take a breath for a minute. I'm going to see if there's any questions in the chat. Can everybody hear me? Can everybody see the deck? All right. Next. All right. So how do we measure impact? There is no one standard measurement at this time, and it is the million-dollar question. So you can tell how new and how on the fringes it is because we haven't figured out a standard way to measure impact like we do, you know, your income statement, your balance sheet, and generally accepted accounting principles that we see on the financial statements. So some examples are it gets a venture or an investment will get compared to how did this relate to the U.S. Sustainable Development Goals? Where did it come in along that? There is another measurement called social return on investment. So we've had return on equity that we've looked at. I'm not sure if you looked at return on investment as part of the curriculum. And I have to say it's a very fragmented space. I'm part of a small incubator group or an incubator group that's globally based. And there's a group within that group that is working on evaluation measures for impact investing. So impact investing on the fringes, not yet a big market in terms of assets under management. What's driving it is the values. Our society is changing. And the important themes, climate change, affordable housing, accessible education, accessible healthcare, is really how do we take that into account when we are looking at our investments. So my call to action to you at the Young Investor Society is, as you go forward, consider not only the financial return on an investment as you're reviewing your investments, as you're doing the stock pitch, as you're looking at your investments in the future when you get your first jobs, look at the positive social and environmental impacts that investment can potentially make as well. All right, open for questions. I'm going to take a breath.
All right. Well, thanks, Rebecca. I have a question in the chat. It says, how do you find companies that are making an impact if it's not being reported in their annual report?
Yeah, no, that's a really good question. And it is hard. It's hard. It's more about going to some of these, it's looking at some of the factors. It's looking at specific investments, and some great places again are the Impact Investing Institute out of the UK, the Global Impact Investing Network. There are some charities out there, the Rockefeller Foundation, that will show you some of the investments that they have. And if you do if it's not in their annual report, well, it won't be in their annual reports because a lot of these aren't public companies yet. If you Google impact investments, you will see various bodies. And again, it's a very fragmented space right now, which means like like an industry, there will be a consolidation at some point. Yeah, thank you. That's a great question. Who's next? Jack.
what are some of your favorite companies that fit into the impact agenda area group?
So right now, my favorite companies are actually the little companies that I look at that aren't publicly listed, that I will go through and be asked to look at their what is it? Their financial statements. And one of them was, I can't tell you the exact names, but I can tell you what they did. One was a data analysis company in the medical field. One was an airline that was servicing a woman-owned airline, a female-owned airline servicing northern communities. And they were doing a lot of flying in of supplies. And here in Canada, what's happened is some of our major airlines now have stopped servicing the northern communities because of the cost to them. So those are two of my radar scope right now. So again, it's on the fringes. They haven't graduated yet to the world of public investing. I'm trying to think of one of my ones in the public markets. I got to think about that one too, Jack, but I really appreciate the question.
All right, does anyone have any last minute questions for Rebecca before she heads out?
All right, well, thank you so much. I so appreciated chatting with you tonight, and thanks very much for your feedback. And Christine, thanks for doing the rehearsal today too.
Yeah, no problem, Rebecca, anytime. I loved having you. Thank you so much for taking the time to tell us about impact investing. Super excited of what that's going to look like in the future. So you guys, next week, same time, same place. I will see you there. Bye, guys.
Thank you.
Thank you. Good night.